Hello friends, welcome to learning sessions, and this is a part 3 video related to the market risk. We have already covered the topics related to the back testing, stress testing, and further about the VAR, the types of VAR, value at risk. We have already covered the things. So please do confirm the audio video quality at the earliest if you are able to hear me out. And this is a class 9 for the BFM, Bank Financial Management, and we are covering module B for now. Module B is the most important module, and if you want all the videos and PDFs for this series, just simply WhatsApp me. Simply WhatsApp me writing CAIIB updates. You need to write CAIIB updates and you need to WhatsApp it to the number 83609 44207. And you should also be downloading our application, which is available at the link iibf.info/app. Here is a link. And if you're iOS user, use this ORG code so as to log in. Now, audio video quality is working all fine. So let's start the session. Let me just give you a synopsis related to the previous video. We were covering the different type of limits and the triggers, and also we covered the multiple points related that how we can be managing the risk and how the risk related to the and how come the risk related to the market, that is a price risk, can be managed. We have already covered these points so far, right? So now moving ahead, it's related to the models of analysis. It's related to the models of the analysis, right? Let's say I've already told you that we are having the different type of models through which we can be analyzing what quantity of the risk is there, right? And further, we can be having multiple type of the financial models and multiple type of the softwares which may be used in the financial model, so that we can measure, we can quantify that what amount of risk is there and what is the position of the market risk there. So it is a risk policy committee, RPC we can say, which is to basically ensure that what model is to be used, and they will be giving the complete policy for the same and full documentation of these financial models to be done, that how they are going to quantifying the risk and what is the hidden agenda behind them and everything related to it, right? So through that we do cover each and everything. So it's about the models of analysis, and there should be no any unauthorized changes or unintended changes to those particular models, and if any single change is there, that should be documented properly. And after that, it's related to the risk reporting. Now if you want to manage the risk, you should be reporting the risk. Like, there should be proper communication system across the different tiers, across the different levels of the hierarchy, so the risk information can basically be traveling from one point to another. Either way, it could be related from top level to the bottom level, and from bottom level and to the top level, right? And reporting should be regular, it should be in time, it should be accurate, and if there is any portfolio risk concentration or any exceptional event, that should be reported. Well versed narration should be there, and it should be concise also. Like in this scenario, you can find out how reporting can be done. It says that Mr. X takes a position in stock A and wants to explain to his boss about the market position. He can explain the position in 3 possible ways, and you have to tell which one is the best one. The first one, it says that he tells his boss that he purchased 1000 shares of the stock A at rupees 600 per share. He just told that I have taken this position. That's it. That I purchased 1000 shares and I purchased the stock of company A at rupees 600 per shares. Now that's indicating that our total exposure is 6 lakh rupees. In second way, he told that we have taken a position of 6 lakh in the stock A. Simple as that. So these two are almost equivalent, right? The third one, it says he tells his boss that he has invested in stock A. He explained that if price changes by 1%, he would be having impact of 6,000. But since the price is expected to fluctuate 3% on daily basis, that is given to be the daily volatility, the figure estimated from the past data, he estimates daily potential loss to be 41,874. Now this is actually given to be the VAR. This is given to be VAR, that is a value at risk, and the volatility is also given, that is a daily volatility of 3% is given, right? And moreover, it's given with 99% of the confidence level. Like the deficiency factor, we say to be it's at the 99% confidence level. And what would be the Z value at 99% value? What would be the Z value for it? It will be 2.33. I just told you in the last video also that at 99% confidence level, the Z factor is equal to 2.33. And for 95% confidence level, the Z factor is equal to 1.65. It is equal to 1.65. Right? So this would be the most effective one. This would be the most effective method. So it's about the reporting, that how do you report the things. And after the reporting, when you have made the reporting right, let's have a look at this factor, right? It's all already just mentioned whatsoever we have read above. It's just mentioned that thing. Market factor, it's a stock price because you have taken the position in the stocks. Market factor sensitivity is rupees 6,000, that is 1% of the total position. That's a sensitivity factor, that for every single 1% the change is 6,000. The volatility, daily volatility is given to be 3%, and deficiency period is 1 day, that is sell the stock, and deficiency factor is 3% volatility, and value at risk is given to be 41,874. Is that clear? Kindly confirm. Are you clear with these points? I know these things may be new to you, but I'm trying my best so as to make you explain all these things in such a manner so that you can be understanding them very easily, right? So please do confirm that you have understood the concept or not. So the market factor sensitivity is 6,000 here. That is basically for 6,000 for every 1% change in the stock price. So if there is any 1% change in the stock price, the for 6,000 rupees changes will be there, right? Total position is given to be 6 lakh rupees. Daily volatility, that is standard deviation. That is standard deviation sigma is given to be what? It is given to be 3%. That's estimated from the historical price movements. Deficiency period is basically, that is a holding period. That's a holding period. That is 1 day. That's basically the time required that we can be liquidating our position. That it's just 1 day we require to hold the position, and after that we can be liquidating our position. Confidence level is given to be 99%. That 99% of the times it's working all fine, right? The overall risk is been up to 41,874, and only 1% chances are there that your risk will be going beyond 41,874. Okay. After that, it's about the risk mitigation. Now we can never be reducing the risk to zero. So whenever someone says that they can be reducing the risks to zero, it means they are going to give up their profit ability. They're going to lose a profit making ability, right? So whenever we are trying to eliminate the risk, we also lose the positive side, right? That we also lose the profits also, right? So risk mitigation in case of market risk, if we talk about, it's related to that we are to adopt some strategies, right? Let's say we are to reduce the volatility. For that particular case, we are to change the variability. And if we are able to change the variability or volatility, then it means that we have been able, that we have eliminated the, or we have reduced the market risk, right? So now let's have a look at those strategy. The first strategy is related to that we are to reduce the downside potential or downside variability of the cash flow, right? But whenever we are trying to reduce the downside potential, as I just told you, whenever we are trying to do so, we are reducing the upside potential too. Whenever we are trying to reduce the downside potential, in a way or another, we are reducing the upside potential too. That's one thing, right? And further, risk mitigation strategies, wherever it is involving the counterparty, definitely there can be the counterparty risk also. Now, whenever we are having some mitigation strategy, let's say we purchased some derivative, right? Now, whenever we purchase some derivative and let's say third party is involved with whom we are going to make a contract, right? Or we are going to make a deal for reducing our risk. In that scenario, we are reducing one risk, but the other risk may rise. That is a counterparty risk, right? Let's say case we purchase an insurance from the insurance company. Now in that particular way, we are going to reduce our risk related to the stealth, related to fire, burglary, etc, etc, right? But what if the insurance company has never been able to fulfill their obligation? What would be in that scenario? So there is a counterparty risk now. So that's basically the point related to it. Okay, so whenever the counterparty is involved, definitely the counterparty risk will increase. The counterparty risk is increased. But in those particular derivatives where the exchange is involved or it is exchange traded, in that scenario the counterparty risk is substantially reduced. That's substantially reduced. But in case of the OTC deals, let me just give an idea related to the derivatives here so that you can understand this particular point. So the derivatives are not having the value of their own, and those are having the value related to the underlying assets. And these could be of two types. Either these are over the counter traded or these are exchange traded, right? So when I'm talking about these are exchange traded, it means those are standardized in format. Those are standardized in format, and the intermediary party is the stock exchange, right? Which takes up each and every responsibility related to the completion of deal. And in that scenario, the counterparty risk is very much negligible. But in case of the over the counter deals, there are two parties because it's a bilateral contract. Let's A is making a contract with B. So for B, there is a risk that A may be failing in fulfilling their obligation, and for the A, the case is that the B may be failing in fulfilling the promise, right? So that can be the thing. So that can be the part, right? So that's the risk is available in case of the OTC. What type of risk? Counterparty risk is available in that particular scenario. Now let's have a look at the risk mitigation strategies. Now, as I told you, the first thing would be related to that we are to reduce the overall volatility. Now, it may be the case that you can be dealing in two different instruments. Let's say one particular instrument is producing the effect of minus 17 and the other instrument is producing the effect of minus 8. Now, when we'll be averaging them out, the average will be 12.5, minus of 12.5 something, right? It means what? That we can be reducing the overall impact. We can be reducing the overall impact if we are having the different volatilities, right? That way we can be reducing our risk. Okay, so volatility of two different instruments may be different, right? That may be different, but that may be helping you out so as to reduce the overall risk, right? So you can be creating a desirable portfolio in that particular way when you're having the desirable volatility characteristics with you. Different instruments which are having the different volatility characteristics associated with them. Is that clear? Okay, now we are going to take some example related to it. So let's say case we are having a portfolio, and in that portfolio we are having two bonds, bond A and bond B, and the BPV, basis point value of 675 and 205 respectively. Now you are having the BPVs. The one bond is having the BPV, basis point value of 675. The other bond is having the BPV of rupees 205 respectively. Now the weighted average BPV of the bonds portfolio would be equal to what? It will be 675 plus 205 divided by 2, that is 440. Now let's take the case we even want to reduce it further. Now we will be adding one another bond we will be adding one another bond to our portfolio such that in that scenario the BPV is less than even 440. So let's say case we added a bond with BPV of 200, with BP of 200. Now in that scenario, what will be the average? Average will be 675 plus 205 plus 200 divided by 3. So the overall BPV will now be even be reduced than the 440. So answer will be 675 plus 205 plus 200 and divided by 3, that is 360. Now it is coming around 360. Are you getting this point? Are you able to understand this point? So this way we can be reducing our overall risk, right? Averaging it out. And similar strategy is also possible when we are going for the sensitivity measure duration. Let's say we are having the portfolio assets with the different durations. Now we'll be going for the bonds with the lesser duration. Definitely that is going to help us so as to reduce the overall duration of our portfolio. Why lesser duration? Because I just told you more is a duration, more is a variability, more is a risk associated with it, right? So you should be having these fundamentals clear with you. Whenever I'm telling you the basics, you should be keeping your mind concentrated toward those particular things. More is a variability, more is a risk, more is a variability, more is a duration, more is a duration, more is a risk, right? And what when more risk is there, more capital is required or lesser capital is required? Answer it at the earliest. If the risk is more, in that scenario, the capital will be more capital will be required or the lesser capital will be required. It is a case of more capital will be required. Let me just write this for you. So if you're having more variability, in that scenario, what it indicates? It indicates that more volatility is there. More volatility indicates that definitely the duration is also going to be more. And when more duration is there, more risk is there. And when more risk is there, we do require more capital so that we can be absorbing the risks associated with the same. Okay. This is about the very first chapter that we have studied related to BFM Module B. After Module B, we'll be covering Module A. Now, the second strategy is the strategies using the correlation measures. Correlation measures. Correlation is represented by R, right? And its value is ranging from -1 to 1, -1 to +1. Right? So if a value of R is equal to 0, it means there is no correlation. If R value is equal to +1, it means highly positively correlated. Means if one point is increasing, the other point will also increase. The other variable will also increase. That's a positive correlation. And what about the negative correlation? When R is equal to -1, it indicates the value will be decreasing. The one value will be decreasing and the other value will be increasing, but in opposite directions. Perfect inverse relationship. This is perfect positive relationship. This is perfect negative relationship, right? Now, this is what we require. Let's say case that the two instruments or the two assets are having the negative correlation. Now, in that scenario, you're going to take the position in those instruments, right? Now, if the market value of one instrument is going to increase, the market value of the other will decrease, right? Let's just take an example that you invested into the stock of A. You invested into stock of A, you bought the stock of A, right? And on the other side, you short sell the futures. You short sell the futures of stock A. Now, short selling means what? That we have taken a selling position under the stock, right? We are under a short position and we will be buying at a lower price so as to make the profit, right? So in case of short position, we are going to be benefited if the prices will drop, and when we have bought the stock, we'll be benefited when the prices will be on the higher side. That's the case. Okay, so this is basically related to positive and this one is related to negative. But the point is, let's say I have invested rupees 1 lakh into stock and 1 lakh notional amount into futures of A, right? Now, how this is going to help me? You'll be asking that if the prices will increase, the future price will decrease. But the point here is that the futures price may be increasing or may be decreasing, but not in the same quantum. Not in the same quantum. They're not going to increase or decrease in the same quantum. Or let's say the case you have taken the position under the stock A, buying position or long position on stock A, and the short position in the Sensex index, you have taken the position, right? That will be helping you so as to basically lower your losses. That is how it works in case of the correlation measures. Now let's have a look at this example. Just have a look at this example over here. So if the price of the stock moves up, say, let's say you have taken a long position in stock A. Long position in stock A, like I told you, long position means that you have bought the shares, all right? And short position in futures of stock A means you have sold the futures, right? Now, if the prices of stock, say, let's say those are up by rupees 10, the stock future will be going up, but not exactly, because the futures also work on demand and supply system and the other market factors. Okay, so let's say it is not increased by rupees 10, but it's increased by rupees 9. The portfolio will gain rupees 10 on account of the long position where we have bought the price, and we will be losing rupees 9 on the short position that we have made, right? But the point is the reverse is also true. Reverse is true in such a manner that, let's say, if the price is dropped, the price of the share A dropped by rupees 10, right? But the prices of the future dropped by 9 only. Now you gained rupees 9 from the futures, but lost only rupees 10, right? So the overall net loss is limited to rupee 1 only, right? So this is how you can be limiting your negativity. You can be limiting your downside potential, right? I know that you have lost your positive potential too. Otherwise, you must have earned rupees 10, but now you're earning just rupee 1 over there, right? But that is all the risk mitigation is all about. That you are going to let the positive potential too, because you want to safeguard yourself from the negative side too, right? So that's the case. Now let's have a look at the strategies for the using the market instruments. We can be using the different type of the market instruments there. Now the financial instruments are available like options, which provide us with the methods as to hedge the market risk. Now, do you understand about the options, or I should be telling you? Let's discuss about the options. About the options. Now, option is a derivative. Option is also a derivative, right? And it gives you a right. It gives you a right, but not an obligation. Right means you'll be having the authority that if you want to go that way or not. So it won't be an obligation on you. Okay. And the options are of two types. Either it can give you right to buy, or it can give you a right to sell. So whenever we are talking about it, it's going to give you right to buy. We are talking about the call option. We are talking about call option. And when we are going to talk about it, it's going to a right to sell. We are talking about the put option. We are going to talk about the put option. So there is a call option and a put option. The call option gives you a right to buy, and put options give you right to sell. So you may be feeling that it's a complicated process, but trust me, it's not, right? Let me just give you a complete example for the same. So let's just consider the factor that the share is having the price spot rate of rupees 100. It is having the price of rupees 100, right? And you pay a premium whenever you are to buy a option. You have to pay a premium for it. Let's say we have paid the premium of rupees 10 per share. 10 per share we have paid the premium. And let's say you are going for the call option. First of all, call option gives you a right to buy, right? And the call option can be, let's say, it can be exercised at the price of rupees 115. It can be exercised at 115. So 115 would be strike price, the price at which the option can be exercised, that is a strike price, right? Now let's say it's having the maturity, the option is having the maturity after 1 month, right? And on the date of maturity, the market value of the share, the first point that we consider, the market value of the share is rupees 155. The market value is 155. Now, would that be favorable to us or not? Any idea related to it? Just say yes or no, right? Just a lame guess. It may be helping. At least make a guess related to it. So, yes, that would be favorable. So that is a favorable condition. Now, how come this is favorable condition? The prices are on the higher side, even if we compare it with the strike price. Now, listen to my words carefully. I told you that the call option gives you a right to buy. At what price? At the strike price, right? Now, the market price of the share is above the strike price. Okay. So you are having the right that whatsoever the price in the market is going on right now, you are having the right that you can be buying this share at rupees 115. The market price is 155, but you still can be buying at rupees 115. Definitely it's favorable now. Now what you have to do so as to make profit, you'll be buying at rupees 115 and you'll be selling at rupees 155, right? Making a profit out of it. So definitely it's a favorable position. And whenever the options are favorable, we say it to be ITM. We say such position to be ITM. That is, we are in the money. We are in the money, right? And the second point, if we consider, let's say the price is 115 only. Now it will make no difference. Why? It's a no profit, no loss situation. And whenever we are to look into profit or loss position, we are not to consider the premium here. First of all, for the position like I'm talking about the ITM part, like if we are to designate if the position is favorable, unfavorable, or no, making no sense to us, right? So that's basically what we are not to consider the premium amount. I know we have paid the premium of rupees 10 per share also, but we don't consider it for that particular part, right? So it is 115. So we'll be saying it's no profit, no loss situation because I can also be purchasing at the same price from the market. Now the market price is also 115 and the strike price is also 115. So I can be buying it from the option writer also and I can be buying in the market also. So no difference to me. So it will be the case of ATM, that is at the money. At the money. We can say this is no profit, no loss situation. And the third, it's related to, let's say the price in the market is 100 rupees. Now in this scenario, I can be buying at the lower price in the market. Why would I be buying from the option seller? No need for that. So it's not an obligation. So it's not an obligation to you that you have to buy from the option seller only, right? So it's not favorable. So this point, the deal is not favorable. And when one thing is not favorable, in that scenario, we say it to be OTM, that is out of money. Out of money, right? So you must have understood about the options so far. I've told you each and every possibility related to the call option, right? And whenever when we'll be doing the topic related to the derivatives under the treasury, I'll be telling you about the put option and the numerical related to this also, right? So the call option gives you a right to buy and the put option gives you a right to sell. Now you can be using these instruments so as to hedge yourself, so as to safeguard yourself, right? And option gives you a right, so it's not an obligation. It's not going to be an obligation, but definitely it comes at a cost. You have to pay a cost for it, and the cost is what? Cost is a premium which is to be paid to the option writer, right? So call option gives you a right to buy and put option gives you a right to sell, right? That's the case. And in the both cases, we want to arrest the downside movement. Now we are going to basically arrest the downside movement. Okay. So that's the case related to it. I hope that you must have understood the strategies related to the market risk. And with this, we are ended up with the chapter number 4 of the BFM. Now we are going to solve a case study for this. We are going to solve a case study for this, and this case study is related to the value at risk and the sensitivity. This is related to the value at risk, volatility, and the sensitivity. Okay, so this case study would be available for the premium members in the application after this particular video. So do give this video a like and make sure to download the application, which is available at this particular link, iibf.info/app. So we have already learned about the different concepts of the value at risk, sensitivity, and the volatility, also in the chapter number 1 and also in the chapter number 4. So we are going to cover a case study for it. So the case study says, and Indian public sector banks treasury holds, and Indian public sector banks treasury holds rupees 1200 crore modified duration based government securities trading portfolio classified under the HFT, held for trading purposes. So it's under the trading book. The portfolio consists of multiple maturities, but has been consolidated for the risk measurement purposes. So we are having the following data available with us. We are having the portfolio market value of 1200 crores. The modified duration is given to be 6.8 years. The daily yield volatility is 9 basis points. Confidence level is given to be 99%. Holding period, this is a defense period, is 10 trading days, and Z score at 99%, we already know it is 2.33 value, right? And parallel upward yield shock considered plus 25 basis points. Whatever these points are, I'll make you understand each and every point. Do not worry about it. Just try to consume this case study first of all. Correlation between the yield movements across maturities is 0.85. Now this correlation is positive. I told you, correlation value varies from -1 to +1. So this is a positive correlation, not a perfect positive relationship, but highly positive relationship, right? Correlation. And the bank uses a variance covariance, means parametric approach or the deterministic approach or whatsoever the approach you say of the VAR model as per the RBI aligned Basel III market risk framework, right? So we have to assume, like in the VAR, we do assume that we have the normal distribution of the returns and the square root of the time rule is applicable, and volatility already reflects correlation adjusted portfolio behavior. So these things are already given to us, right? So this is a complete data or complete data set which is available to us, and we have to solve the question for this. So the first question, it says calculate the percentage and absolute loss in portfolio value. We have to calculate the percentage and absolute loss in the portfolio value due to the parallel upward yield shock of 25 basis points using the modified duration. So the first step would be related to it, that we have to calculate the percentage price change. I told you very clear formula related to it. Like in the case of duration, I told you a formula. The duration formula was equal to summation of sigma PV dot T, that's the time weight value of the present value, and divided by the present value of the bond. This was a formula related to duration, and it's represented by D. And what do you mean by what is the formula related to modified duration? It is duration divided by 1 plus R, where the small r value is equal to YTM divided by small n value, right? So that was the value related to it. So it is YTM divided by small n. Is that clear? Is that clear to you? Now, under the modified duration, I told you one further formula, that percentage price change, that would be equal to negative of the modified duration multiplied by the change in yield. This was a formula. This is very much important for this particular question, right? So that was a formula. Now the change in yield is what? Change in yield in the question is given to be 25 basis points. A parallel upward yield, right? So this is change in yield. So this is plus 25 basis points. Now 1 basis point is equal to 0.01. So 25 BPS would be equivalent to 0.25%, right? So the change in yield is known, right? And modified duration is also given, and modified duration is given to be 6.8 years, right? So it will be 6.8. So what will be the answer? It will be minus 6.8 multiplied by change in yield is 0.25%, means 0.0025. We have to convert it to decimal part, right? Change in yield. Clear? Now we'll be solving. So it is 6.8 multiplied by 0.00017. 0.017. So this is actually the percentage lost, right? And when we'll be converting it to percentage, it will be 1.7%. 1.7%. Now there is a positive point. Now the value will be reduced or decreased. It will be decreased. It will be decreased, right? Because the percentage, it has increased. There is a positive percentage increased. So if the interest rate increases, the bond prices will reduce. So the loss would be equal to what? The portfolio size is 1200 crores, na? It is given in the question that the portfolio market value is 1200 crore. So the loss would be equal to 1200 crore minus 1.7%. So 1200 minus 1.7%, that is 1200 crores into 1.7%, that is 20.4, right? So loss is equivalent to 1200 crores multiplied by 1.7%, that is 20.4 crores. This is the absolute loss, right? This would be the absolute loss. Clear so far? Please confirm. Now let's move toward the second question. Compute the one-day VAR of the portfolio at 99% confidence level. Now what is the formula for the VAR? What is the formula for the VAR? Now we have to calculate the parametric VAR. We have to calculate the parametric VAR and very much easier formula related to it. I've already made you understand the formula for the same. We have already solved the question for this. And what will the formula related to it? If you remember, anyone? We have to calculate one-day VAR. So what will be the formula under the variance covariance approach, parametric approach, or the deterministic approach for the VAR? VAR is value at risk, right? And I told you the clear formula also. I told you the clear formula also. So it is daily volatility into the under root of the time horizon. Daily volatility in under root of the time horizon and multiplied by the investment multiplied by the Z value. So the formula is quite easy. So VAR is equal to whatsoever the investment value is there multiplied by the adjusted volatility for the time horizon, or we can say volatility over the time horizon, whatsoever the time period is given to be for which we are VAR to be calculated, multiplied by the Z value or Z value over here. That's the formula related to VAR. That's the formula related to the VAR. Now in this scenario also the same thing is to be done, right? So we are having the value of the investment amounting 1200 crores. It is 1200 crore, right? And what is the daily yield volatility? What is the daily yield volatility? Let's have a look at the question. Now the daily yield volatility is given to be 9 basis points. Now from the daily yield volatility, if we multiplied with the modified duration, then we will be able to get the daily volatility. So we have to multiply 0.09% means 009 with 6.8 that is a modified duration. So as to get what? So as to get the daily volatility over the time horizon or the volatility over the time horizon, right? So it will be this way. So I'm just mentioning over here, it will be Volatility over the time horizon would be equivalent to what? Your yield volatility, daily volatility, or we can say simply modified duration multiplied by the daily yield volatility. Daily yield volatility, right? And then we have to multiply it with the Z value. And Z value for 99% confidence limit will be equal to 2.33. Now just solve this thing. So VAR for the 1 day would be equal to what? It will be equal to 1200 multiplied by 6.8 multiplied by 0.0009 and multiplied by 2.33. That comes out to be 17.11. It comes out to be 17.11 CR. This is your 1 day VAR. 1 day value at risk. That under one day time horizon, if you are going to make an investment, then the maximum loss under the normal conditions is limited to 17.11 CER, and only 1% chances are there that your normal loss can be going beyond 17.11 CR, right? After that, the question number 3, calculate the 10-day VAR assuming volatility scales with time. 10-day VAR. Now for 10-day VAR, we have to calculate the volatility for 10 days. So volatility for 10 days would be equal to what? It would be equal to daily volatility multiplied by time period under root. This would be the formula. So it will be equivalent to what? That the daily volatility that we have calculated, that's coming out to be what? That's coming out to be 17.11, and multiplying it with the time period, time horizon, that will be equal to what? That will be equal to under root of 10, under root of 10. That will be related to a 10-day VAR. 10 days VAR, right? Why this one? Because see, we look at the VAR formula, and the VAR formula was quite simple. What it was? It was equivalent to the investment was 1200 crore multiplied by adjusted volatility. Now the adjusted volatility would be equal to the daily volatility, that is 0.000009 over here, multiplied by modified duration, that is 6.8 over here, right? Now this value we have already calculated, and this complete value we already calculated to be 17.11, so I wrote it directly, right? We just need to multiply it with the under root of 10, that's it. So it is 17.11 into under root of 10, just a shortcut to it, right? Nothing changed. So it is 10 under root, that is 3.1622 multiplied by 17.11, so it is 54.10 or 54.11, right? So 54.11 CR. This is what? This is the 10-day VAR. This is the 10 days VAR, right? Have you understood this part so far? Now, let's go to the next question. It's about determine whether duration-based stress loss or the 10-day VAR is more conservative and by how much crores. Now we have to determine, we have to compare the points, compare the things, right? Now for, if you remember, the 10-day VAR, it's around 55 crores or something. It was 54.11. It is 54.11 CR, right? And what about the duration shock? Let's have a look at the question. So it should be given in the question about the duration shock. See, the duration shock is upward yield with 25 basis point value. and there was a loss, absolute loss, right? That was of 20 point something crores. We calculated about it. It is 20.4 crore. We have already calculated in the first question, right? So already clear to us, right? So it is 10-day VAR, it is 54.11. And further, if we look at the duration shock due to the basis point value, we lost a value of around 20.40 crore, right? Now, if we look at the duration based stress test or 10-day VAR, which one is more conservative? Now, which one is more? Definitely the 10-day VAR is more, right? And that will, the difference would be 54.11 minus 20.40 crores. So that will be answer. So it will be 54.11 minus 20.4 crore, that is 33.71. 33.71. That will be the related answer to it, right? So that was all about this case study. So there were 4 questions related to duration, and for the calculation of duration, if the item is given, we have to calculate the duration. How can you be calculating? 5 columns are to be prepared. Which 5 columns are to be prepared? The first column would be related to the time, that when you'll be getting the cash inflow time, right? T. The second column would be related to cash flow. The third column, C, would be related to the PVF, present value factor or discount rate, right? And the fourth column would be related to the present value multiplying B with the C. That will be the D column, and E column would be D multiplied by A, that is PVT. PVT. Okay. So these 5 columns are to be prepared whenever we are to solve the question related to the duration, right? We have already covered that in the previous video. So that was all about the market risk. And in the next video, which is going to be tomorrow, most probably, right? Definitely, I'll be informing you in the channel also, because I'm to go out of station. So it may be the case that the video may not be there, but I'll be informing you in advance. So we are going to cover in the next video about the credit risk. So make sure to join our channel. So subscribe the channel. And if you want to get the complete course, just do download the application from the link iibf.info/app. And you can be using the ORG code, that is GEGKT. So you have to use the ORG code GEGKT if you are iOS user. And make sure to download it. And if you want the PDF and everything, just do WhatsApp me on the number 83, writing CAIIB to the number 83609444207, and I'll be sharing all the details with you, right? Thank you so much, and see you again in the next video. Happy learning.